Well, first of all, I'd much prefer to be with you and holding our clients' hands and explaining what we think is going on at this point in time rather than at the highs. And I think our biggest concern is that our investors turn what we believe are temporary losses into permanent losses. Now, what's interesting from a flow point of view, just before we get to the answer to your question, last year we did inflow. A lot of that was front-end loaded. It was $17 billion. And in the last 30 days, we are inflowing again, net inflowing a little less than $500 million. So what we believe is happening is because we give our research away, because we are so transparent about what we're doing, and because our research is so good, I think it is the best in the financial world when it comes to disruptive innovation. I believe that there are individuals who are reading our research and saying, hey, this makes a lot of sense. I didn't know this. I did not know that there are 5 platforms involving 14 different technologies that, if we're right, are going to move from being valued in the equity markets, public equity markets, at $10 trillion to roughly $210 trillion within the next 8 years. That's a 46% compound annual rate of return. There is one market that is getting this right. It's the private market. Last year, and you're right, we have had a significant decline. If you look at our peak, which was February 12th of last year, so roughly a year ago, and you look to the trough, which we believe was January 27th, that was a 57% drop. But if you looked at our appreciation from the depths of the coronavirus to February 12th, that was a 358% increase. And so we're seeing a lot of analysis of our performance out there, which is cherry picking, dates. And I've just given to you what has happened. And there's endpoint sensitivity to these dates. If you look at our returns on a 5-year rolling basis, and what I mean by that is take monthly returns and do 5-year rolling averages, we have outperformed both the S&P and the NASDAQ 100% of the time. If you take the same on a 2-year basis, I have those numbers here, we have outperformed the S&P 500 90% of the time, and NASDAQ 81% of the time. We've just been through a significant downturn, a correction relative to the peak, and we do believe that innovation is in bargain basement territory. And there's just one other thing I'd like to add here. I went through the tech and telecom bubble. And know very well what that feels like. And what we learned was that there was way too much capital chasing too few opportunities too soon. And the internet had been brought to life, and the dreams that investors had and the valuations based on potential eyeballs maybe 10 years out caused investors to fall all over themselves to try and raise their technology positions to north of their benchmark. And the benchmark had gone to 35%. That was a mistake. Too soon. The technologies were not ready. The costs of those technologies were prohibitively high. Cisco, Oracle, the traditional players back then were not going to bring us into the cloud and artificial intelligence age. They're completely different companies. And even today, I look at the S&P 500's 28% in technology. We do not own one of those technology stocks. Those are either mature technology stocks. In the case of Microsoft, they've done a wonderful job migrating towards the new world. But our technology stocks are way undervalued relative to their potential, whereas we do not believe Microsoft is. And I'll just add one last thing. Today, we have investors doing the opposite of what they did during the late 90s. They are running for the hills. It's risk off because of inflation, interest rates, and the hills are their benchmarks. So they're running to the past. And if we're right, and the disruptive innovation that is evolving is going to disrupt the traditional world order, those benchmarks are where the risk is, not our portfolio. So in a risk-off period, that is going to happen. We believe our portfolios are extremely undervalued. You have to have a 5-year investment time horizon. And if an investor is looking for returns over the next quarter, the next 2 quarters, we can't promise them. Nobody can promise them. That's a macro call these days. However, if you give us 5 years, I will tell you, we are running a deep value portfolio. And I've even had this confirmed. One of our largest clients, our largest institutional clients, actually called me and said, you know what? I'm a value guy. And he heads up the equity division of this state pension plan. He said, I'm an equity guy, but I'm value oriented. He has other people allocating to the growth side. But he called me and he said, you know what? I'm investing in some of your stocks because I believe that you are right on the transformational technology here. And I love it when I see investors running away, all with the same story and for the same reason. You'll notice what we do during risk-off periods, and this one has been particularly long, 1 year, which has taken our stocks into bargain basement pricing, I'll say again. But the names you read have migrated into our top 10 because we have concentrated our holdings towards our highest conviction names. And most of the names you read are in our top 10. I think many of them are platform companies. Many of them are going to harness artificial intelligence in a way that others cannot. I mean, Tesla has been the best case in point, and I think we have a lot of Tesla-like stocks in our portfolio. We're really looking for companies that are going to use artificial intelligence and create competitive advantages that no one will be able to catch.